A few weeks ago, we talked about America crossing $40 trillion in debt and why there's no interest rate that fixes it. This week, media headlines exploded with claims that the US government tried to fix the bond market and it failed within 24 hours. On Tuesday, the 30-year Treasury yield hit its highest level in 19 years, and the next day the US Treasury stepped in and announced that it would double how much long-term debt it buys back. Markets cheered, yields dropped, and by the next morning commentators declared the move a failure because yields went right back to where they started and kept climbing into Friday. So by the end of this video, I'm going to show you the real opportunity. I'm going to show you why the media completely misunderstood what the Treasury was doing, why yields refuse to stay down, and where the money leaving this mess is already going in a way that's breaking one of the most reliable rules in the market. Start with the number most people never look at. This year alone, the United States has spent roughly $1.2 trillion just paying interest on its debt. Not paying the debt down, no, just servicing it. And it's accelerating because in July, the federal deficit came in at $432 billion in a single month, the largest monthly shortfall since March of 2021, which pushed the year-to-date gap to almost $1.8 trillion. For every dollar the government borrows, it has to convince somebody to lend. And the price it pays to convince them is the yield, which means when the government's borrowing costs move, they don't move in isolation. The 10-year Treasury is the benchmark mortgage rates are priced off of. Auto loans, credit card rates, small business credit, all of it sits downstream. So that 19-year high isn't a bond market statistic, it's your mortgage, your car payment, and the cost of capital for every company you own shares in, all repricing at once. So when the Treasury stepped in, headlines claimed they were trying to suppress those rates, and that the attempt failed. But what did the Treasury actually do? When financial media declared this move a failure, they were judging it by the wrong metric entirely. They assumed the Treasury was trying to force interest rates down. But to see why that's wrong, you have to know what a buyback actually is, and this is what I'm going to explain to you right now. When the Treasury buys back a bond, it's purchasing existing debt out of the market. But it funds that purchase by issuing new debt. The old bond goes away, a new one takes its place. The total amount of government debt the market has to absorb doesn't shrink, not by a dollar. What changes is where that debt sits on the curve and how easily it trades. It's a liquidity tool. It smooths out the parts of the market that are trading badly, freeing up bank balance sheets so institutions can keep participating in auctions. And that's where the media got it wrong. Let's use an analogy to better understand this. They judged a routine oil change by whether it made the car go faster. The mechanic didn't fail just because the car didn't gain 50 horsepower. No. Officially, the government never claimed this would push rates down. Treasury Secretary Scott Bessent went on television and clarified that this was about supporting liquidity and smoothing out trading in older bonds. The Treasury's Advisory Committee has said the exact same things. Buybacks are for liquidity, not for managing the overall size or yield of the debt. The Treasury didn't fail, the plumbing worked. But the reason yields spiked right back up is because the market is facing a supply and inflation problem that a liquidity tool cannot fix. Which leads to the real question. If the Treasury cleaned up the plumbing, why are investors still demanding higher yields? Because the money didn't disappear, it went somewhere. It went exactly into the AI build-out, not into the AI stocks, into AI debt. The companies racing to build data centers, secure power contracts, buy chips, lay fiber have been funding it by selling bonds, and the scale of it has caught almost everyone off guard. Financial services tracking this counts roughly $220 billion of hyperscalers' AI-linked bond issuance, a 17-fold jump from the $12.5 billion issued over the same time frame last year. That total now makes up around 13% of all investment-grade corporate bond issuance in the US. Now think about who buys long-dated treasuries. Pension funds, insurance companies, sovereign wealth funds, bond funds. These are institutions with a fixed amount of capital to deploy and a mandate to earn a return on it. And for the first time in a long time, they have a genuine alternative, high-grade corporate paper from some of the most profitable companies on the planet, paying more than the government does. So the US Treasury walks into in that room and asks them to fund a 6% of GDP deficit. But they're no longer the only serious borrower in that room. That's why yields bounced right back up. The Treasury can clean up its market plumbing all day. It cannot make pension funds accept lower yields when persistent inflation and competing high-grade debt exists. I'm 5 minutes into a video about bond auctions, like the most boring thing in the entire world. But this is the mechanism, and there is a payoff, because once you see it, you cannot unsee it. It explains something that happened this week that shouldn't have been possible, because if this were just an American issue, you'd expect it to stay American. It didn't. In the same week, the 30-year hit its 19-year high. Japan's 10-year government bond yield reached its highest level in 3 decades. German 30-year bonds hit their highest since 2011. France's 30-year went back to levels last seen in 2008. Yeah, I think you remember that year. 4 different governments, 4 different fiscal situations, 4 different central banks, all repricing at the same time in the same direction. And that matters because it rules something out. If this were about a failed American Treasury operation, it would have shown up in American bonds and nowhere else. Japan doesn't reprice because of a US buyback, but what all 4 have in common is the other side of the trade. The pool of global capital willing to lend money for 30 years at a fixed rate is finite, and everyone is drawing from the same pool while pricing in sticky global inflation. So this isn't a policy failure that a better headline fixes. It's the price of long-term money going up everywhere at once. And when the price of money changes that fundamentally, the rules that everything else is measured against start to bend. One of them just broke. We'll get to that rule in a moment, but put yourself in the seat. You're the United States. You owe $40 trillion. You're adding to it at roughly 6% of GDP a year. And the interest rate alone is running about $1.2 trillion annually. The people who lend to you just told you what they think of the risk by keeping yields high. What do you actually do? There are only 5 options, and that's not a figure of speech. Mathematically, that's the list. Option 1, the preferred one. You grow your way out of it. If the economy expands faster than the debt does, the problem shrinks away on its own. This is the honest answer, the one everyone is hoping for, and it's arguably the entire bet behind the build-out we just talked about. And America has done it before. After World War II, public debt peaked around 106% of GDP, with a total debt topping 118%. By 1974, it had plummeted to 23%. That's the story you'll hear every time someone tells you not to worry, that we grew our way out of it. Except, that's not the whole story. Economic studies show the real growth only did part of the work. What did the rest? High post-war inflation, which spiked to 17.6% in 1947, combined with explicit financial repression. The Federal Reserve pegged long-term interest rates at 2.5%, effectively capping yields, so bondholders suffered years of deeply negative real returns. So the celebrated example of America growing out of its debt is actually the example of America inflating out of it. Keep that in mind because we're going to come back to it. And there's a second history worth knowing here, because it's the closer parallel. In the 5 years after 1996, American telecom companies spent more than $500 billion laying fiber optic cable, financed almost entirely out of debt, and built before the demand existed. The justification was a number everyone repeated. Internet traffic was doubling every 100 days. It wasn't, it was doubling about once a year. And between 1999 and 2004, less than 5% of that fiber was ever switched on. 60 plus companies went bankrupt. Global Crossing alone collapsed owing $12.4 billion. Now, here's the part that matters, because they weren't wrong about the internet. Every prediction they made about how much bandwidth the world would eventually need came true. That dark fiber became the backbone of the cloud. They were just early. And being early when you're carrying debt is indistinguishable from being wrong. The bondholders don't get paid in vindication. So when someone tells you that the AI build-out will justify itself, they might be completely right, and it still cannot save anyone the debt in the meantime. Look at what the growth has to beat right now. Roughly 6% of GDP in new debt every year, with interest compounding on top of the old. Growth has to outrun both at the same time for years without interruption. So even if AI delivers everything that is promised, that arrives over a decade, the hole gets dug every quarter, and growth is the right answer to the wrong timeline. Now, we spent quite a bit of time on this supposed option 1, we expanded a bit, but let's go through the next ones more quickly. Option 2, you cut spending, and here the arithmetic is brutal, because the majority of federal spending is social security, Medicare, defense, and interest. Interest isn't optional, that's a contract, which leaves the three most politically protected line items in American life. No administration of either party has cut them at the scale this requires, and none is going to. Cutting Social Security or Medicare deeply enough to matter is political suicide, and everyone in Washington knows it. Then we have option 3. We raise taxes. Same wall, different side of it. The increases required aren't marginal, and every one of them is a vote nobody wants to take. And of course, theoretically, there is option 4 where you default, you tell the world the debt won't be paid. But for the country that issues the world's reserve currency, this isn't an option. It's a detonation, and nobody's picking this either. Which leaves option 5. You don't refuse to pay. You pay every bond on time in full. In dollars that are worth less than the ones you borrowed. You don't erase the debt, you shrink what it means. And we saw exactly how that's done in 1946. But nobody announces option 5, there's no press conference for it. It just happens through inflation running hot, through rates held lower than they should be, through a currency that quietly drifts down year after year. And the bond market doesn't need an announcement. It reads the same list you just did, gets to the same place, and prices it in ahead of time. But who do you think actually ends up paying this debt in option 5? It's you. Or maybe not you so much, it's the cash holders. That's why long-term yields refuse to stay down. It's a repricing of what a dollar is going to be worth on the other side of the debt. Now, getting to the rule that's breaking. There's a relationship in markets so consistent that most people treat it as a law. When yields go up, gold goes down. The logic is simple, gold pays you nothing, no dividend, no coupon, no interest. So when a government bond starts paying you 5% to sit and wait, holding a metal that pays you 0 looks worse by comparison. Money leaves gold and goes where it gets paid back. That relationship has held up for decades. This week, it didn't. Yields went up, the dollar went down, and gold went up right alongside them, closing out its third straight weekly gain. That's not supposed to happen. But here's why it did. The number quoted on the screen, the 5% plus yield, is the nominal yield. It's not what you actually earn. What you actually earn is that number minus inflation. And if inflation expectations are rising just as fast as the yield is, then your real return, the thing that actually determines where your money grows, hasn't improved at all. You're being paid a bigger number in a currency that's losing value at the same rate. The headline goes up, but what it buys you doesn't. And that's the moment the rule breaks, because when rising yields stop signaling economic strength and start signaling that real purchasing power is eroding, gold stops competing with bonds, it starts competing with the currency itself. That's not a rate trade anymore, that's a vote of no confidence. So the question is where the vote is being cast. But if gold is no longer trading like a bet against interest rates, and it's trading like a bet against the dollar itself, then the question isn't complicated anymore. Where does the money go when it's fleeing a currency, not chasing a rate? It goes to the thing that isn't anyone's liability. Gold isn't a promise from a government or a company, nobody can print more of it, default on it, or vote to change what it's worth. That's the entire case in one sentence, and it's exactly what we laid out when we covered America crossing $40 trillion in debt. Some of the most conservative money managers on earth were already positioning for this before this week ever happened. Now, if you want direct exposure to this, that's gold itself, you have to look no further. If you want to add leverage to the move, that's where miners come in. And it's why I highlighted some of these stocks in the previous video. They have done wonderfully since. But the idea is when gold runs, miners' margins expand faster than the metal price itself because their production costs are mostly fixed. That's not a new peak, it's the same one, just getting a second catalyst on top of the first. And we start here briefly on the larger time frame because I wanted to showcase the potential. It's more than most people would believe it to be capable of. But this is the most likely path to me. And what I'm looking at is a wave 5 of a much larger wave 3. The wave 5, in such a large degree, wave 3, tends to be quite extended, often ends up being close to the size of the wave 3 itself, sometimes even surpasses it. But we aren't talking about just any asset here. We are talking about an asset that people flee to when there is fear. And the wave 5 is when this fear tends to peak. If I were to track the internal structure of the wave 3, I can showcase this to you. This is a 1, 2, 3, 4, and a 5. The wave 5 itself ended up being the largest rally in this entire structure. The same thing could happen to this wave 5, but honestly, even if it doesn't, I wouldn't expect this to be the end of the rally. I would expect gold to continue to rise over the next decades. I could argue that this wave 1 would have already formed a more significant top. This wouldn't have been a tiny one too. But even in that case, we still have previous rallies, previous waves 1 and 2 to build up on into much larger degree structures. Now, with all of that said, I don't expect gold to find a lot of trouble getting into the $8,000 region. I believe it capable to do a lot more, but before we build on those expectations, let's have some more patience, let some of the smaller time frame structure build, and once we have more evidence, we can even get a more accurate target. And what the smaller time frame is telling me is that we are on a bullish path. We have a few options on how this could unfold, but in all of them I'm looking for continued rise, whether that is after a small correction or not. Firstly, I want to get it out of the way. I'm not 100% convinced that this is a wave 1. Okay? It could be the case that we already have 5 waves up, in which case we would be looking for the 3-wave correction in wave 2, in which case we might need even deeper levels of support than what we have here on the screen. And firstly, to already get it out of the way, I'm not convinced that this is the beginning of the rally. I am open to considering this to be the bottom of the wave 4, in which case we might already have a top within a 5-wave pattern. This would imply a 3-wave correction that could even push below this area of support theoretically. The support levels in that case, however, would extend down to $4,100. You could use quite accurately the 38.2% retracement here. I would expect it to be quite relevant, which is even in line with the 78.6% retracement, but I didn't want to clutter the chart too much. And I have 2 more points, both of them regardless of whether this is a wave 1 and a wave 2 or not. It doesn't really matter. It could be that the correction from the wave 3 top didn't actually end here, in which case this would be a wave 3, it would allow a wave 4 correction and then a 5th before this structure is even complete. Which brings me to my next point, where if the wave 3 has stopped here and the correction ended here, the proportions of this as a wave 4 and this as a wave 2 aren't too good of a match, and we could be looking at something significantly more bullish, where the bottom of this correction would be no wave 4, it would be a wave 2, in which case what is building right now within this structure would not be a wave 5, but a much more extended wave 3. It is true that it is not necessary by any means for it to follow this exact path, and I could very well consider that the wave 3 top had actually completed here, and this is an ABC structure within the wave 4, in which case the proportions would be a perfect fit. And this is probably the most likely path, where within this white wave 5, we are looking for one additional low and one additional high before this structure is complete. But what follows after is either a correction in a wave 4, in which case the relevant area of support would be this, assuming a top is in, maybe adjusted slightly higher if we see another extension, or wave 2 in the case that the large wave 4 had bottomed here. This was more for those of you who are interested in the smaller time frame, the technical details. Let me know if you are interested, and you didn't need to hear any of this anyway. I will adjust in the future, but my main idea remains the same. I'm not looking to time this. I'm looking at this to be an incredible opportunity, and whether we get this as a wave 1 top and we get a wave 2 correction, it could very well top within this white area of support, within strong rallies, which this could very well become one. We do not need to see deep retracements, and there is a much more directly bullish path. It is true that some structural resistance is still ahead of it, and I expect a bit of a larger correction than what we have had so far within this entire rally to happen before we actually take off. But the fundamentals are outstanding here, and trying to catch the bottom might leave you out of a quite powerful rally. And I want to be clear, gold isn't the only place this opportunity shows up. It's just the cleanest example of it. When a currency's value gets called into question, the whole category of things nobody can print or promise into existence starts to matter again. That's precious metals as a group, not one metal on its own. And silver belongs in that category. It's not one government's debt, it's not a company's promise, and its supply is just as fixed as gold's. But it's not a pure copy of gold's trade. Silver also gets consumed. In solar panels, electronics, industrial demand gold doesn't have, so it's carrying 2 arguments at once. The same store of value case as gold, plus a usage case gold doesn't have. And here I actually prefer the structure, the path I suggested in the case of a hyper bullish gold pattern. Silver has been holding back in the last couple of weeks. It has seen a decent rise, it has broken some relevant levels of resistance. But the structure here seems to be preparing even more clearly for a directly bullish breakout. Not to be mistaken with guarantee that this will work, however. And I wouldn't ever dare tell you what to do with your money. This is simply my analysis of it. But what I'm looking at is, again, the potential of this wave 4 to have actually bottomed here. I'm not convinced this is the low. I believe in trications, I believe this could have been one. And in this case, I see an impulse within this structure that could have very well been the wave 1 top and a clear 3-wave correction in a wave 2. From this point, we see the momentum spike and we see another 5-way move to the upside. Could it be that a wave 2 correction is coming into this white area of support? Well, yes, that is a possibility. But it's the same concept on silver. I'm not looking to time this. It's just the earliest area of support I would consider for direct continuation higher. And certainly this as an internal wave 1 could extend directly higher. Yeah, it could get, let's say, another 4th and a 5th to complete a larger pattern. I wouldn't have a problem with that. But until it builds this stepping stone, I find it a little bit harder for it to simply see the direct breakout, for it to simply get into the wave 3 of the wave 3. But honestly, I'm not looking for anything bearish in the case of silver until it breaks the beginning of this entire structure, right below $57, right? $56.70 around that area. Unless that is broken, I'm not looking for anything bearish. It is true this internal white area of support could very well break and the bullish case would not be actually destroyed. It could go right into these previous lows before it forms a bottom, finding structural support right under $63. It's not an uncommon level to find a bottom, as other patterns still remain a possibility. I could still track this as a larger leading diagonal to be built, in which case a wave 4 would have a sweet spot for reaching these levels, for bottoming exactly in that area before taking here a 5th and having a larger wave 1 be built. So my point stands, I'm looking for the bullish path to continue one way or the other unless it breaks $57. So to bring it all back, the Treasury didn't fail because of bad execution. And the buyback wasn't a broken policy. It did its job, keeping the markets plumbing clear. But the liquidity tool can't fix the actual underlying problem. Too much debt, sticky inflation expectations, and AI capex competing for capital. And when the government runs out of doors, the last one left doesn't come with an announcement. It just shows up in what gold and silver are already telling you. If you haven't seen the video where we first laid out the $40 trillion number and why there's no rate that fixes it, go watch that next, it should show up on the screen. This one builds directly on it. This is one piece of a much bigger picture and there's more of it coming. But for now, these are the levels, this is the trade setup, I hope you enjoyed the video, and if you did, don't forget to leave a like, subscribe, and if you enjoyed the content and want to support it directly, check out the channel membership and I'll see you in the next one. Bye bye.